Now what this means is over the course of a month, we have some cash flows that counter each other. We have the cash in and we have the cash out. Now if we look in January and February, we don't have any cash in. Yet when we're buying things where we've got some cash out, none in January. Now I'm assuming this is kind of a brand new company, so if we were ongoing, then we'd have some payables going on in January from December. But assume we start January 1st, we don't have anything that we're paying for in January, but then we pay for it in February. Good corporate customers who actually bought it in January pay for it in February. Same with February's purchases, we pay for it in March. So second from the bottom, we have our cash outflows. The very bottom in the lighter blue, we have our net cash. Okay, net cash. So we have cash in and cash out during the same time period. And what happens is those cash flows usually don't match each other. And in some months we have zero cash flow, zero net cash flow. We might have some going in and some going out, but they pretty much equal each other. Some months we have a negative cash flow. We're paying out more than we're getting in. And then some months we have a positive cash flow. Okay, so net, and we see it across bottom, nothing going on in January. February, we pay out 10 more than we get in. March, we pay out 5 more than we get in. And April, we're actually even. And May and June, we're ahead a bit. Okay, so this intuitively makes sense once we think about the flows in business. Now, the big danger comes along when we look at the cumulative cash flow. And this is the scary part, because I hear business owners saying, well, you know, February, March is a bit slow, and you know, we lose some money every month, but not a big deal. It's only $5 in this instance. It's only $5 a month or $10 a month. It's not a big deal. But here's the problem: these things accumulate. So if we take our cash flows from the previous page, and we have nothing going on in January, but we've got a minus 10 in February, a grand total of minus 15 in March, okay, because those add up. April, we don't lose any money, but we don't gain any either. So we still got minus 15 in April. May, things start to turn around. We're at minus 5. In June, we're at plus 15. Okay, so just think about that for a second. This means that February, March, April, even May, we're in the negative. So unless we've got a strong reserve of cash or something like that, that means that money to pay our even just our payables has got to come from somewhere else. This doesn't include all of our rent and all that sort of fun stuff. So we've got to have some reserves, because even though things are turning around in April, we still owe a fair chunk of money right into May. This is the danger of having a seasonal business, and this is the part that hangs up most small business owners in one way or another. Yeah, well, I'm only losing $5 a month. Okay, but if you add that up over 6 months, you're into 30 in a negative situation, which is really bad for the cash flow. So this is something we really have to look at, and a budget is what helps us do that. Now, to simplify things, I've assumed that there are no cash sales and no cash purchases, which will skew things a bit. But we've also got other cash events that aren't on that spreadsheet or on the previous slide. We've got to pay our salaries, our rent, interest, utilities. Sometimes we have to buy some new equipment or things like a new roof, something like that. And we've got to pay off our loans and interest and maybe even pay some dividends. So these are the other parts of the budget, the cash budget, that we have to think about. Just done the payables and the receivables so far, but there's a lot more to it than that. Now, further notes on the budget. We take out payroll taxes since they're flow through. For instance, if I take income tax off of your paycheck, I give that to the government. It's not a revenue or an expense. The employer portion, however, so if I take off $5 in CPP, I give that to the government, but also I have an expense to match. It's a matching rule. So I have to give $5 from my own money to give to the government, and that's an expense. Okay, so we got the payroll taxes themselves are just flow through. I take from you and give to the government, and there's part of it that is actually a matching expense. And to cover that in a budget, what we do is we often just gross up the pay that we pay people. So even though I might pay you $10 an hour, you actually cost me $11 an hour. That's just a really simple formula of 10% extra. But that's basically what we're looking at in Ontario, depending on all sorts of other things like workers or WSIB and rates and that sort of thing. But this is what we're talking about. So we gross up, we add up all of our expenses when it comes to employees and just do a straight line across the one line on the budget. Okay, but the actual taxes we collect are just straight through. We do account on the budget for the company's income tax payments. Usually they're every 3 months. Okay, and we can account for HST, but we don't do it in this course. Again, it's a flow through, or any provincial sales tax. It's a flow through. We collect it, we give it to the government. So it's not a revenue or an expense at all. Now, if we're starting up in the capital expenditures are going to be pretty large, and the HST portion is going to be pretty large. We might want to keep track of that just for initial loans and cash flow and that sort of thing. But typically, after a while, we don't really worry too much about that. Again, because it's a flow through. If the company's profitable, not a big deal. So in a cash budget, we've got all these things going on: the receivables, the payables, credit sales, our expenses, our cost of sales, or purchases, whichever one we get a hold of, plus our payroll and our rent and all those fun things. I can't squeeze that onto a PowerPoint, so we're going to move into a Excel situation after the next slide. Okay, just some quick terms. For what we're up to, purchases equals cost of sales, and we don't include any direct labor in cost of sales. We have to pay our employees usually fairly quickly compared to some of our suppliers, so labor is not included in payables. Purchases on credit become payables. Now we call them trade payables. These are suppliers, inventory, contract labor, which is a little bit different than your regular help. But contract labor could be plumber, something like that. Freight in, shipping, etc. Doesn't include long-term debt or shareholder loans. Okay, these are called trade payables. Sales on credit become receivables, are also known as trade receivables, and don't need to explain that too much. So if you sell something and they pay for it with a debit or a credit card, it's the same as cash. Okay, credit cards mean that whoever's using the cash or the card is getting credit from another company. They're not getting credit from you. If somebody pays you with a credit card, you get cash. Usually within 48 hours, it gets dropped into your bank account. In the old days, it used to be anywhere from 2 weeks to 4 weeks. But thanks to the internet and other fun things like that, typically if we're selling to somebody and they pay us with a debit card or a credit card, it lands right in our bank account within the next few days. So we don't track that as a receivable, and we don't issue an invoice for it either. Okay, so as far as we're concerned, it's cash. So just keep that in mind. A check is considered cash as well. And you're going to see the term COD. It's not talking about a fish. We're talking about cash on delivery. The idea there is if I deliver something to your door, I don't actually physically give it to you until you give me the money. Also known as a cash sale, really. Okay, but we see these terms everywhere, so I thought I'd better put this one in there before you ask me what's a COD or get an email on COD. Cash on delivery. That's all it means. Okay, so we're going to do an Excel slide, and it's only going to do actually receivables and payables as well. I kind of want to get that down. We'll add in the full-blown cash budget next week. Okay, so we're just going to do running through a quick one, and then the actual lab assignment will be a little bit bigger.